Wall Street's most exclusive club consists of companies with market caps over $1 trillion, and Netflix wants to add its name to that list. The entertainment giant's ambitious growth targets, including doubling revenue and hitting that market cap milestone by the end of the decade, underscore its growing dominance as the world's largest streamer. Shares have nearly doubled in the past 12 months thanks to a strategic shift that has strengthened revenue and cemented the company's position as the top global streamer. So can Netflix keep the momentum going, or are these targets based more on fantasy than reality? On this episode of Growth Stories, we look at Netflix's bold goals and explore whether the streaming titan is poised for a blockbuster performance or a disappointing fizzle. Netflix is one of the top-performing stocks in the S&P 500 so far this year, and the streamer, popular for original shows like Black Mirror and Bridgerton, is aiming for a lofty valuation target by the end of the decade.
Back in April, the Wall Street Journal reported that Netflix wanted to hit $1 trillion market cap and double its revenue by 2030.
That's Barron's tech reporter Angela Palumbo. She adds that the company also wants to triple its operating income and reach 410 million subscribers by 2030. Now, these figures are based on internal company conversations and are not official guidance.
These are pretty big target goals that investors are paying attention to now.
To put in perspective, Netflix's market cap was roughly $550 billion in early July. So the company would have to nearly double that in the next 5 years to hit that valuation target. While these growth goals may seem like a stretch, Palumbo points to recent performance as proof the streamer is within reach.
In the last 12 months alone, the stock has gained about 90%, and it needs to gain about another 85% to hit that $1 trillion goal. So if you look at the numbers, it doesn't seem impossible, but it is definitely something to keep an eye out for right now.
These numbers are particularly impressive given that just a few years ago, Netflix stock suffered a steep decline, losing nearly half its value in the first half of 2022. That period marked the streamer's first subscriber loss in over a decade as pandemic lockdowns lifted and more competition entered the market. Now, to be fair, this move also coincided with a substantial bear market, so Netflix wasn't the only stock suffering during this time. But Palumbo credits a shift in business strategy to Netflix's recent rebound.
To think ahead how they can continue to grow, we have to look at what they've done in the past. So back in 2022, they implemented their ad tier, which at the time was a little controversial. Analysts on Wall Street thought that current subscribers were going to try to cut back their spending and go from, instead of the current subscription, to a lower priced subscription, and that would hurt their revenue.
But Palumbo says those cutbacks never happened. A year later, Netflix started its crackdown on password sharing, a move that also helped drive a surge in new subscriptions. In the first quarter of 2025, which also marked the final period Netflix will disclose subscriber numbers, the streamer added 18.9 million global subscribers.
They had the option to pay a little bit less for the same content. They would just have to watch ads. And those ads brought in revenue for Netflix.
While Palumbo attributes Netflix's recent resurgence to this strategic pivot, she emphasizes that the real challenge now lies in maintaining that momentum. So how can the streamer sustain its growth trajectory to achieve a 13-figure market valuation?
Well, they can raise prices, of course, and that's something we're seeing across industry. They can also just continue to bring in exciting new content. People are really looking forward to the new Stranger Things, the new Bridgerton. How do they continue to bring in original content that's going to hold on to subscribers?
Third Bridge analyst Scott Kessler says the company's newest business segment will also play an important role.
How would they be able to get there? How could they get there? I think it probably would have to be driven by advertising.
Kessler says that while the company's ad-supported tier was slow to pick up steam, the segment has recently gained momentum. Viewers who chose the ad plan pay $6.99 a month compared with $17.99 for an ad-free account. Antenna Insights, a leading provider of data and analytics for subscription media services, estimates that Netflix's lower-cost ad-supported plan accounted for roughly half of all new paid subscriptions between January and April of 2025. That's an 11% jump compared to the same period last year.
Netflix has been around for a long time. This ad business has been around for a couple of years, essentially. I don't think there's any question that we're still in the early stages of them developing the offering and really perfecting how they go about monetizing.
Kessler says Netflix's ad business will drive growth over the next few years, and people have high expectations. eMarketer, an industry research firm, estimates that U.S. ad revenue for the streaming giant will top $2.15 billion this year.
Just the nature of the offering, where you get essentially a subscription fee as well as related advertising revenue. That's something that I think is very attractive from a business model perspective.
But not everyone on Wall Street shares Netflix's optimism. Analysts expect annual revenue to surge 87% to $72.8 billion by 2030, which would fall short of the company's internal sales targets. Barron's reporter Angela Palumbo says lingering economic uncertainty could further complicate the growth picture.
Netflix is in an interesting position because obviously they're not an Apple or an Amazon, right? They don't import products, they don't sell products, they have a service. And that service is, we thought, pretty insulated from tariffs. And even if Netflix doesn't feel cost or impacts from tariffs internally, they could see people externally saying, I can't afford rent this month. I can't afford all of these other things. Let me cut back on non-essentials. And that could include their streaming services.
But analyst Scott Kessler suggests that an economic slowdown wouldn't necessarily mean canceled subscriptions.
The ad-supported tier gives Netflix more flexibility than they had before, because perhaps people previously might have said, all right, well, it's an all or nothing determination. Either I'm going to subscribe to Netflix or I'm not. Now there seemingly are multiple options where, you can downgrade the nature of the subscription so you still get the service, but maybe not, in as robust a way. Or yes, maybe you're going to pay less and accept advertising as an alternative. And then that provides an opportunity where they can retain those customers.
Experts say future growth will depend on the success of Netflix's advertising platform.
They are still in the process of launching a lot of the advertising tools that will enable marketers to get on the platform and reach the Netflix audience, but it's still early days.
That's Third Bridge analyst Scott Kessler again. He says Netflix has a lot of work to do to strengthen its ad platform to catch up to streaming competitors like Amazon.
But the reality is that Amazon has been around since the 1990s, gathering data and information about its user base, and they're able to use that in the context of building an advertising business, which, by the way, even before the launch of the Amazon Prime Video advertising supported tier, they already had a very substantial and actually robust advertising business.
Netflix is set to bring its ad technology in-house this year, moving away from its initial 2022 partnership with Microsoft. This will give the company more control over its advertising future.
You can envision a scenario where, they start incorporating data and information. They're able to more effectively target, and then they have the infrastructure to really allow advertisers to come on and buy advertising in a way similar to the way they do that in a variety of other contexts with other providers of such solutions. And so as they ramp that up, that's going to really also help the operating margin profile as well.
The deployment of artificial intelligence tools should also give Netflix's ad revenue a boost.
If you are a tech company and you're not talking AI right now, you are light years behind, and Netflix is no exception.
That's Barron's reporter Angela Palumbo again. She says Netflix will start incorporating AI-generated ad breaks that will blend in seamlessly with its shows and movies. This technology will complement existing AI algorithms used for content recommendations on the Netflix platform.
If you go on your account, you'll notice that the suggested things for you could be very different than another person in your home on their own account. The content that is suggested to you is helped through AI generation. That's very intentional. They want to keep people on the platform. They want to introduce people to shows they want to see.
Kessler says Netflix's user experience is considered the industry gold standard, and for good reason. Engagement is a key to revenue growth. He adds that the streaming market can be inherently volatile, with subscribers frequently cycling through various services rather than sticking with one streamer for an extended period of time.
Engagement is hugely important because if folks aren't using the product, the next step is maybe they're not going to continue to pay for the product.
Netflix is heavily investing in live events to drive subscriptions and boost engagement rates, with sports being a major focus. The streamer's live sports debut came in November, with a golf tournament featuring stars from its popular Formula One series. Netflix also paid $150 million for the rights to broadcast 2 NFL games on Christmas Day, and in January aired the first WWE Raw event as part of its $5 billion deal with the popular wrestling league. The company is also in talks with Spotify to potentially partner on projects like live concert series and music award shows. Analyst Scott Kessler offers more details on the company's plans.
I know they're pursuing live versions or spins on some of their reality type shows, some of their competition type shows. I think live events are super important to how the company thinks about engagement and growth.
Netflix hopes its investment in live events will translate into subscriber growth within an increasingly crowded market that includes competitors such as Amazon Prime, Disney Plus, and Warner Bros. Streaming services.
In terms of just broader competition, Netflix does lead the pack. They have the most subscribers of other streaming services, and choices that they've made are becoming industry standard. For example, the password crackdown, that's something other streamers are starting to do because they want to see the growth that Netflix is seeing.
Palumbo adds that of all the paid subscription-based streaming services, Netflix is the largest with the most subscribers. But Alphabet's YouTube is in the lead for most screen time overall.
YouTube is a really interesting part to the streaming story because everyday people might not be thinking about it as a streaming competitor, and that's really because it's free.
According to Nielsen data, YouTube accounted for 12.5% of US TV viewing time in June 2025. That's more watch time than any other entertainment company. Barron's reporter Angela Palumbo highlights a key differentiator. YouTube's content is largely user-generated and typically available for free. She adds that YouTube also stands out from the competition when it comes to children's content.
Now people are watching Miss Rachel, Bluey, etc., and these streaming services are trying to get the eyes on those shows. And Miss Rachel is interesting because on YouTube, she gets hundreds of millions of views on her videos. Netflix just announced earlier this year a deal with her, and there's a couple of her videos on Netflix. However, her content is still available for free on YouTube.
So what should investors focus on as the streaming giant pursues its ambitious goals?
I would say a key takeaway for investors is the stock is really outperforming this year, and the valuation is high, but it's very important to remember that no company is completely insulated from what's happening right now, and to just keep an eye on those growth targets. And it's going to be up to the individual investor if they want to hang on to see if they can hit them or not.
These are big companies with big budgets. It's going to continue to be a dogfight. I think Netflix, it has a head start, it has a large user base, and it has a massive content budget as well as plans to spend in the future. So they're well positioned, but it will remain super competitive.